Hey everyone, and welcome to this deep dive. We're cracking open Lloyds Banking Group's 2023 annual report, and trust me, it's packed with insights.
Oh, it is. It's fascinating to see how they navigated such a dynamic year.
Right. Okay, so first impression, just the sheer scale of their operation jumped out at me. Lloyds supported almost 600,000 businesses last year. That's a massive footprint on the UK economy.
Absolutely. They're deeply intertwined with the UK's financial fabric, especially when it comes to businesses.
And it's not just about the numbers. I was really impressed by how proactive they were during the cost of living crisis. They were really thinking about how to support their mortgage customers and those with lending facilities.
Yeah, it speaks to their commitment to a more inclusive and sustainable future. It's not just about profits. You can see that reflected in their partnership with the charity crisis to push for more social homes.
Speaking of the future, Lloyds is all in on digital. They've got a staggering 21.5 million digitally active users. That's even more than their 2024 target. I'm willing to bet many of you listening are part of that digital crowd.
It's a smart strategy. This digital strength lets them tailor services and build deeper relationships with customers. Think about it. 18 million customers have signed up for targeted marketing communications. They want that personalized experience.
And they're using that digital edge to target growth areas,
Hmm.
like their acquisition of Tusker. They're a leader in salary sacrifice for low-emission vehicles.
Well,
So smart tapping into that sustainability trend.
exactly. It's a win-win. They get the revenue growth and it aligns with their sustainability goals.
Another interesting move is their focus on the mass affluent market with Lloyds Bank 360. It's a mobile-first wealth management service. But what I found really interesting is they've included financial coaching,
Yeah, that's a great touch. It shows they're actually invested in empowering their customers to take charge of their finances.
and it's working. This segment has already grown to 2.5 million customers. Definitely a market with huge potential. Okay, let's talk financials. Lloyd's reported a statutory profit after tax that's actually higher than 2022. And that's even after taking into account changes in their accounting methods.
Impressive, right? And they're sharing the success with their shareholders. The ordinary dividend is up 15% to 2.76 pence per share.
Music to any investor's ears. But of course, it's not all sunshine and rainbows. Operating expenses rose by 17% to 10.8 billion. We need to unpack that a bit. It includes planned strategic investments, costs related to new businesses, and of course, the impact of inflation.
I was glad to see the transparency in how they broke down those costs. They specifically called out 675 million in remediation costs. Basically, that's the cost of addressing past issues and making sure customers are treated fairly. Not ideal, but it shows accountability.
Okay, let's get to the heart of it, net interest income. That's up 5% to 13.8 billion.
A healthy increase. This is largely driven by a stronger net interest margin of 3.11%. It reflects the difference between the interest they earn on loans and what they pay on deposits. They've benefited from UK bank rate hikes, but also their own smart hedging strategies.
Speaking of risk management, Lloyds has a solid CET1 ratio of 13.7%.
Right, CET1, it's essentially a measure of a bank's financial strength, like a buffer against unexpected losses.
Ah, okay. And they're planning to reduce this to 13.5% in 2024. What's the thinking there?
Well, holding too much capital can actually be inefficient. It ties up funds that could be used for other things like investments or shareholder returns. It's about finding the right balance. Enough capital to meet requirements and weather any storms, but also using their resources effectively.
It's a delicate dance.
Mm-hmm.
All right, let's talk shareholder value, dividends and share buybacks. How's Lloyd's doing? We already mentioned the dividend increase, but it's worth repeating. A 15% jump is nothing to sneeze at.
It shows their commitment to rewarding shareholders. And it's not a one-off. They have a progressive and sustainable dividend policy. They're aiming for consistent dividend growth over time. That's a big draw for income investors.
Makes sense. And then there's the share buyback program,
Right.
another way to put money back in shareholders' pockets.
Yeah, essentially, they use their cash to buy back their own shares from the market.
So that reduces the number of outstanding shares, which can boost earnings per share.
Right, exactly. It's like concentrating the ownership, making each piece of the pie a little bigger.
Interesting. And Lloyd's has been actively buying back shares in recent years. A clear signal they're serious about shareholder value. Okay, but Lloyd's isn't just one big bank. It's actually made up of different business segments, each with its own story to tell.
You're right. Let's delve into their segments and see what makes them tick.
Sounds good to me. Let's start with the foundation, retail banking, where they serve everyday customers like us.
That's right. But even within retail, they're not standing still. They're very focused on the mass affluent market with Lloyds Bank 360, which we talked about earlier.
Right. What other trends are you seeing in retail banking?
They're laser focused on digital innovation and personalized services. Those 21.5 million digitally active users aren't just a coincidence. They're actively encouraging customers to bank online and through their mobile app.
That makes sense. It's more convenient for customers and more efficient for Lloyds. But I do wonder, are they doing enough to support those who might not be as comfortable with technology? There's always a risk of leaving some people behind at the rush to go digital.
That's a valid point. It's something to keep an eye on as they continue this digital transformation.
Okay. Another key segment is commercial banking, where they cater to businesses of all sizes. What's their strategy there?
They're aiming to digitize and diversify their SME business, especially in sectors where they have room to grow.
So they're actively looking for new growth opportunities.
Yes, and they're backing it up with action. They're investing heavily in technology to streamline processes and improve the customer experience for businesses. They even mentioned expanding their technology center in India to support this growth.
It's a global game now, and Lloyds is playing to win. All right, let's shift gears and dig deeper into those financial highlights. We talk about profit after tax and dividends, but let's look closer at the income statement. What else stands out to you?
Net interest income. It's a crucial metric for banks. As we said, it's the difference between the interest earned on loans and the interest paid on deposits. It's their bread and butter, and they saw a 5% increase in 2023, reaching $13.8 billion.
What drove that growth?
Well, a few factors. The rising interest rate environment, thanks to the UK bank rate increases, has allowed banks to charge more on loans. But of course, they also have to pay higher interest rates on deposits.
It's a two-sided coin.
Exactly. But Lloyds has managed it well. Their improved net interest margin of 3.11% shows that. They've successfully balanced the interest they earn with the interest they pay.
So a favorable interest rate environment plus their own smart strategies have boosted their net interest income. Are there any other significant sources of revenue?
Absolutely. Fees and commissions for various financial services, account fees, overdraft charges, transaction fees, things like that.
Diversification is key. Having multiple revenue streams makes them less reliant on any single source. Okay, let's move on to the balance sheet. What are the key takeaways there?
Their loan book, which is the total value of loans they've extended, gives us insights into their lending activities. It tells us about the health of their loan portfolio. And a healthy loan book is essential for a bank's financial stability.
Absolutely. The report breaks down the loan book by segment, and we can see that retail lending, mainly mortgages, makes up a large chunk of it.
Makes sense. They're one of the biggest mortgage lenders in the UK. But that also exposes them to risk. What if the housing market takes a hit?
Right? That's a big risk factor for any bank heavily invested in mortgages. Speaking of risk, let's revisit capital adequacy. We touched on their CET1 ratio, but it's so important for understanding their ability to absorb potential losses.
As we discussed, they're in a strong position with a CET1 ratio of 13.7%, but they're planning to reduce it to 13.5% in 2024.
Why would they do that if a higher ratio means greater financial strength?
Because holding too much capital can be inefficient. It's like having a big pile of cash sitting around doing nothing. Those funds could be used for other things, investing in growth opportunities or returning capital to shareholders.
Ah, I see. So it's about finding that sweet spot. Enough capital for security, but also deploying it effectively.
Exactly. It's a balancing act. Now let's talk cash flow. It's the lifeblood of any business. For banks, it's about understanding where their cash is coming from and going to other. Are they generating enough to meet their obligations and fuel growth?
What does Lloyd's cash flow statement tell us?
It shows strong cash generation from their core operations. Cash is coming in from interest income fees and commissions, and they're using that cash to cover operating expenses, investments, and dividend payments.
Okay, but what about free cash flow? That's the cash left over after essential capital expenditures. It represents their financial flexibility to reinvest, pay down debt, or return to shareholders.
Their free cash flow has been consistently strong. That's a good sign. It means they're generating more cash than they need for their day-to-day operations.
Flexibility is crucial, especially in these uncertain times. Before we move on, I want to touch on asset quality, another critical piece of their financial picture.
Asset quality is everything for banks. It's about assessing the risk tied to their loans and investments.
Right. A bank with poor asset quality is at a higher risk of losses, which can erode capital and threaten their stability. So how's Lloyd's doing in this area?
The report indicates they have a robust risk management framework and they're actively monitoring their asset quality. They specifically mention their efforts to support customers facing financial difficulties, especially with the cost of living crisis. This proactive approach helps prevent loans from going bad and keeps their loan book healthy.
It's about finding that balance again, isn't it? Being commercially successful while also doing the right thing.
Absolutely. And that seems to be a key theme running through this entire report.
We've covered a lot of ground. Their business segments, their financial performance, their risk management practices. We've given you a pretty comprehensive overview of Lloyds Banking Group's 2023 performance.
But there's always more to discover. Stay tuned for part 2 of this deep dive, where we'll wrap things up and explore what all of this means for Lloyd's future. Welcome back.
All right, so we've got this picture of Lloyds financially solid, digitally savvy, and committed to responsible banking. But the world is changing fast. What do you see as the biggest opportunities and challenges for them moving forward?
Well, let's start with the opportunities. Their digital transformation is a real strength. They've built a powerful platform with millions of active users, and that gives them a head start in attracting customers who prefer to bank online and on their phones.
And it's not just about convenience, it's also about the data. This digital strength allows them to gather valuable data, which they can use to personalize services, develop new products, and streamline their operations.
Data is the new gold, and Lloyd seems to be in a good position to capitalize on that. Another opportunity is the growing focus on sustainable finance. They've set ambitious targets for green investments and lending, and that resonates with investors who are looking for companies that are committed to ESG principles.
It makes sense both from a business and an ethical perspective, but let's be realistic. No business is without its challenges. What are some of the headwinds Lloyds might face?
One challenge is the persistent low interest rate environment. While they've benefited from the recent UK bank rate increases, interest rates are still historically low, and that puts pressure on their net interest margins, the difference between what they earn on loans and what they pay on deposits.
So they need to find ways to grow their revenue without relying too heavily on interest income.
Exactly. Another challenge is the rise of new competition, fintech startups, tech giants. They're all offering innovative financial products and services. These newcomers are often more agile and customer-centric than traditional banks.
It's a wake-up call for the entire industry. Lloyds needs to keep innovating to stay ahead of the curve. And then there's the constant pressure of regulations.
Right. The rules and regulations for banks are always evolving. It can be a complex and expensive landscape to navigate. Lloyds needs to tread carefully.
It's a delicate balancing act. But they do have a strong track record of managing risk, which is reassuring.
They've also demonstrated a commitment to prioritizing their customers, especially during the cost of living crisis. They've taken steps to support those struggling financially, and that can go a long way in building trust and loyalty.
It's about nurturing those long-term relationships, not just chasing short-term gains. So, taking everything into account, what's your overall assessment of Lloyd's future?
I'm cautiously optimistic. They have a solid foundation, a clear strategy, and a strong management team. They're embracing digital innovation, focusing on sustainability, and adapting to the evolving landscape. But they also face some significant challenges, and it will be interesting to see how they address those in the years ahead.
It's a story that's still being written. And we as investors and observers get a front row seat. So we've covered a lot of ground in this deep dive. We've analyzed Lloyd's performance, dissected their financials, and explored the opportunities and challenges they face. But the real question is, what does this all mean for you, the listener?
That's the key takeaway. How will Lloyds shape the future of banking in the UK and beyond? We encourage you to check out their full annual report for even more insights. But for now, we'll leave you with this final thought. As the banking industry continues to transform, what role will Lloyds play in that transformation? It's something to think about. Until next time, keep diving deep.